Welcome to the world of tech investing, where fortunes can be made and lost in the blink of an eye. Did you know that from 2020 to 2022, the tech sector soared by a staggering 132%? That's amazing, right? But here's the shocking part. As of 2023, many tech stocks are now considered overvalued by as much as 50%. This means investors are paying far too much for companies that might not deliver on their promises. For example, a study revealed that about 70% of tech startups are not even profitable. That's a huge risk for anyone looking to invest. Just think about it. If a bubble bursts, it could wipe out billions in value almost overnight. In this video, we'll dive deep into the tech bubble, exploring how it grew, what signs to look for, and why the next crash might be just around the corner. You'll learn about the hidden dangers of FOMO and the psychology behind market trends. We'll also identify the companies that could survive the fallout and share strategies for how you can profit when the dust settles. Stay tuned. This is a ride you won't want to miss. Chapter 1. The Tech Bubble, a ticking time bomb? Tech stocks are riding high, but the question is, how much longer can this last? Many analysts are sounding the alarm. Just like the dot-com bubble of 2000, we're seeing tech companies with sky-high valuations but shaky fundamentals. In fact, as of mid-2023, the average price-to-earnings (P/E) ratio for the Nasdaq 100 is well above historical norms, sitting at around 27. For context, the historical average is closer to 16. This means investors are paying way more for earnings than they should. But here's the kicker: not all tech stocks are profitable. In 2022, 40% of Nasdaq companies posted negative earnings. That's a red flag. It's reminiscent of 1999 when dot-com companies with little to no revenue were still attracting massive investments. What's propping them up now? A mix of optimism, speculative investing, and low interest rates for much of the past decade. But as rates climb, the cheap money that once fueled the tech boom is drying up. That's why this tech bubble feels like a ticking time bomb. Economist Jeremy Grantham said it best: every bubble bursts. It's only a question of when. Chapter 2. Silicon Hype versus Reality. What's really driving stock prices? Tech stocks aren't rising purely because of solid earnings or growth. There's a massive hype factor at play. The metaverse and cloud computing are buzzwords driving investor excitement, but is it all justified? Let's take AI as an example. OpenAI, the company behind ChatGPT, hit a valuation of $29 billion in 2023. Yet, many analysts argue that while AI is transformational, we're still in the early stages of monetizing it. In fact, according to McKinsey, less than 10% of businesses are actually using AI effectively. But despite this, AI-related stocks have surged, with Nvidia tripling in value in 2023 alone. That kind of growth is unusual. It's a clear case of the hype inflating stock prices. But hype without revenue is dangerous. Remember, hype also drove stocks like Pets.com to massive heights in the late 90s. It's not that these technologies won't eventually transform industries, they will. But the gap between promise and execution is wide. Many of these companies won't be profitable for years. If you're investing in tech stocks based on buzzwords, you might want to rethink that strategy. Chapter 3. The hidden costs of chasing growth at all costs. It's easy to get caught up in the race for growth. After all, companies like Amazon and Tesla spent years growing at any cost before turning a profit. But there's a big difference between smart growth and reckless expansion. Many tech companies are burning cash to maintain high growth rates. In fact, about 30% of tech startups in 2023 are unprofitable but valued over $1 billion, a dangerous mix. Uber is a great example. The company has consistently reported losses since going public, despite being a global leader in ride-hailing. Investors kept pouring in money, hoping for future profits. But at what cost? Uber's cash burn in 2022 was nearly $5 billion. While growth is exciting, it's often unsustainable. According to investor Howard Marks, growth for growth's sake is the ideology of the cancer cell. A lot of tech firms are growing their top line, revenue, but not focusing enough on profitability. And when markets shift, unprofitable companies are the first to collapse. So if you're betting on high-growth, cash-burning companies, you might be gambling more than you realize. If you're finding value in this content, please consider subscribing. Stay updated on the latest trends and strategies in investing. Chapter 4. When FOMO turns to fear. The psychology of market reversals. Investing in overvalued tech stocks is often driven by fear, specifically, the fear of missing out, FOMO. When everyone is talking about how much money they're making in the stock market, it's hard not to feel like you're falling behind. A 2021 survey by Charles Schwab found that 40% of millennials invested in the market for the first time because of FOMO. But here's the thing: what goes up must come down. The same psychology that drives prices higher can reverse quickly. When markets start to turn, fear takes over, but this time it's the fear of losing money. The herd mentality kicks in, and investors rush to sell. This is how bubbles burst. In fact, Nobel laureate Robert Shiller once said, "Speculative bubbles are fueled by stories, and stories change." We've seen this happen before. During the dot-com crash, the Nasdaq dropped by 78% from its peak in 2000 to its bottom in 2002. Stocks that everyone thought were untouchable became worthless overnight. The same risk applies to today's overvalued tech companies. So, how do you protect yourself from getting caught in the panic? The key is to avoid following the crowd. Stick to fundamentals, and don't let FOMO drive your decisions. Chapter 5. Disrupting the disruptors. Who's set to survive the fallout? Not all tech companies are created equal. Some are better positioned to survive a market downturn, while others could crumble. The companies most likely to make it through a tech stock crash are those with solid financials. That means a strong balance sheet, consistent cash flow, and, most importantly, profitability. Take Apple, for instance. While it's a tech company, it's also one of the most cash-rich companies in the world, sitting on over $60 billion in free cash flow as of 2023. That kind of financial strength makes it more resilient in the face of market volatility. Similarly, Microsoft continues to dominate in its cloud services with Azure, posting over $220 billion in revenue in 2023. It's not just about growth, it's about sustainable growth. On the other hand, companies like Snap or Peloton, which thrived during the pandemic but struggled to turn profits after, are at much higher risk of crashing. In fact, Peloton's stock plummeted by over 80% in 2022 as demand faded and profitability remained elusive. In the event of a broader market correction, these types of companies will be hit hardest. To navigate this, focus on companies with strong fundamentals. Look for businesses that have pricing power, low debt, and a history of profitability. These companies are better equipped to weather the storm. Chapter 6. Smart Investors Playbook. Profiting from the crash. So, what should you do if a tech stock crash is inevitable? The smartest investors don't just ride out crashes, they find ways to profit from them. Warren Buffett's famous advice comes to mind: be fearful when others are greedy, and greedy when others are fearful. When stocks are overpriced, the best move is often to be patient and wait for opportunities when prices fall. One strategy is to have cash on hand. If a crash hits, you'll be in a position to buy quality stocks at a discount. In the 2008 financial crisis, those who bought after the crash saw enormous gains in the following years. Between 2009 and 2019, the S&P 500 delivered an average annual return of 13%, which was significantly higher than historical norms. Another approach is to diversify. Don't put all your eggs in one basket, especially not in tech stocks. Consider allocating some of your portfolio to other sectors like healthcare or energy, which may not be as affected by a tech downturn. You can also explore international markets for opportunities that might be less tied to the US tech sector. Finally, consider hedging. You can use instruments like options or inverse ETFs to profit from a market decline. While these strategies can be complex, they offer a way to protect your portfolio if the tech bubble bursts. Ultimately, the key to surviving and thriving during a tech stock crash is to stay calm, be patient, and have a game plan. If you enjoyed this content, don't forget to subscribe for more insights and tips on navigating the world of investing. Your journey to financial wisdom starts here.